Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, where my guest is Ned Bell, Chief Investment Officer and Founder at Bell Asset Management. Welcome, Ned.
Thanks for having me.
Ned, Bell is a prominent name in the Australian financial markets. So can you take us through the genesis story of Bell Asset Management and why global equities and specifically small to mid caps really became the area you chose to focus on?
Sure. So I started my career working in the US, actually for a big US equity manager in the late 90s. I caught the bug in global equities, working in Washington, Boston, San Francisco. I saw the last hurrah of the dot-com boom and bust. So yeah, I caught the bug. I just fell in love with the idea of managing global equities. At that time, as you did recall, there weren't a lot of Aussie-based global managers. Clearly, Platinum was leading the charge, but I saw no reason why we couldn't create another global capability in Australia. And so that's what really, I guess, got me or inspired me to build a global equity capability. And then as far as global small mid-cap goes, clearly there's gigantic crowding in the mega cap space, and investors are always looking for other pockets of alpha, whether that be emerging markets or, growth more generally, but small mid-cap is something that is really the missing link. And so I think focusing on that part of the market and trying to build a franchise around that makes a lot of sense.
It's interesting that you mention Platinum because as a pioneer, but do you think that idea that was prevalent back then of, you couldn't possibly manage a global portfolio from Australia, do you think that's been put to bed?
I think it has, and as a case in point, in terms of us as a business, more and more of our clients are coming out of the US and Europe. And when we meet with them, they don't even ask the question. They just think at the risk of stating the obvious, you've also got great managers in Scotland who no one asks them, how do you manage global equities out of Edinburgh? So I think the perspective of US and European institutional investors is somewhat different to Australia, because the reality is we're all a million miles away from many companies in the portfolio. And in a way, COVID was the great leveller. The COVID period showed what it was like for everyone to manage money from Melbourne. We're all in the same boat.
And just on capitalisation, it's often a shock to Australian investors what you actually mean by the parameters of small and mid-cap in global stocks, because it's certainly not what they're used to when they think of the ASX and small and mid-caps.
Yeah, exactly. So we define global small mid-cap as it's the bottom 28% of the MSCI World Index. So in market cap terms, that has an upper limit of about 44 billion US. So in a global context, Woolworths just fits under that cap. So it gives you an idea of the scope that we're dealing with. But it's a really interesting part of the market. There's a lot of, we would have probably 150 companies that we could invest in globally. So you've got a lot to choose from. And in many cases, we'll buy the stocks when they're in that 5 to 10 billion range and grow with them up to about 40. That's really the sweet spot, probably from 10 to 40.
Everyone is concerned about concentration risk in some of the major indices, and it must be, well, it's not as prevalent in your field, but I suppose the flip side of that is that it's still quite surprising that a lot of the companies in your universe are relatively unfollowed.
Yeah, that's right. The concentration risk is huge. If you look at the top 7, mega cap tech stocks in the US, collectively they represent about 18% of the MSCI World Index. And again, there's huge valuation risk that comes with that. When you move further down the market cap spectrum into the small mid cap space, you're absolutely right. They're not covered as well. And particularly when you go into a period whereby Wall Street investment banks are cutting back their research departments, the first that get cut back or get the chop are the small mid-cap analysts. But for us, that's great, because that means that the stocks are not as well understood. And so we direct more of our research efforts there, and there's more scope for opportunity sets.
And I gather there's less and less reliance on sell-side analysis anyway, because you always want to do your own.
Exactly. That's what we do. We invest in our own research, seeing these companies, forming our own views. And one of the big differences is that we obviously take a 3 to 5 year view on companies. At the risk of offending our friends on the sell side, they typically look not too much further beyond about 12 months in terms of their earnings estimates. And it's that period beyond 12 months is often where we see bigger changes or bigger differences between our estimates and those of the street more generally.
Is there any substitute though for getting on a plane and actually going into the office and talking to a management team? Or do you or have you invest without doing that?
No, we'll always eyeball the company face to face. That's really important. But your answer is there is no substitute. You can do Zooms. They're very good for update calls with companies you're very familiar with. But when it comes to particularly assessing a company for the first time, seeing how they react to somewhat uncomfortable questions is always a telling sign. And there are very important nuances between management teams in different parts of the world. So I always say that German companies tend to be painfully conservative. US companies tend to be painfully optimistic. And trying to understand that is, you just need to see the companies face to face.
So what is the biggest red flag when you come down to that final meeting?
Capital allocation is usually the biggest go, no-go sign. So we want to invest in companies who are much more prepared to invest in R&D, invest in organic sales, and invest against, for example, in the COVID period, companies that were investing to improve their position long term. We love those sorts of companies. If we start to see a company who starts talking more and more about M&A, we generally run in the other direction, because 9 times out of 10 that will not work particularly well. It won't prove to be accretive in the way that they expect.
Do you have to be a bit of a poker player in that when you're getting really excited about a company, you don't really want to let on that you are starting to get very animated by the prospect of owning it?
You do. You have to. I think what you need to do, you need to sort of form some sort of rapport with the company. And one of the first things we say to a company is, we're not a hedge fund, because that always gets a meeting off on the wrong foot, because they know that you're going to be negative the whole time. They clam up. They don't tell you anything. So the first thing we say to them is, we are long-term investors, 3 to 5 years. Average holding period's been 6.5 years, I think, for our companies. And so that immediately gets them on the right sort of footing, and the conversation becomes much more beneficial for us, and they're much more willing to talk about long-term plans. So to that degree, you've got to get a sense of rapport with them to get the most out of the meeting.
Let's talk about some of the really big themes that you're seeing in the global SMID space. I mean, there's no shortage of really big themes, but what's exercising your thoughts a lot, both on the positive and the risk side?
Yeah, so I think on the positive side, there's one of the biggest overarching arguments for SMID now. It's the valuation argument. So they are very, very cheap. They trade on about 15.5 times earnings. The 7 mega cap stocks we're talking about trade on 40 times earnings. That differential is the biggest it's been in 10 years. So that's number one. Number two, another thing that we've seen is that during that COVID period, these small mid-cap companies took a massive amount of cost out of their business. So what that means is that they're very well set up for very strong earnings leverage next year. So earnings growth for small mid-cap stocks next year is going to be about 14-15%, and the stocks are very cheap. So that's almost like the rubber band effect, where it's not often where stocks are growing at that rate and they're so inexpensive. So that opportunity set of picking up valuation rebound and getting earnings growth is just not realised by the market. So that's a huge overall market theme. I think another more general theme that we're seeing and doing more work on is the reshoring of manufacturing back to the US. That's really only just started in the last year or so, but that's a 10-year play, and there's a lot of different companies that will benefit from that over the long term.
How do you define quality?
It starts with return on capital. No matter what a company says, it all comes down to high sustainable return on capital. It's the quality of the franchise strength, looking at how good a franchise strength is, and particularly in small mid-cap land management. At the end of the day, it's the guy signing the checks who are really important. Those are probably three of the big categories. Obviously, balance sheet strength, macro conditions come into it, as does ESG. But those are the key ones we look for when it comes to quality.
Obviously, you're a fan of active management because that's what you do, but just how important do you think it is in the current environment? And really, it's something that active and passive has become, for most investors, they really do have a lot of options. And is active, in your view, holding up its end in terms of what it says it will do?
So yeah, it's a really good question. So active management it's been in a tough spot for 10 years. When you've got ultra low interest rates, you just don't get rewarded for being disciplined on quality or valuation. You just don't. But in a way, the way I think about active management now, it's a bit like having car insurance about just before you're about to hit a tree. You don't need it until you hit the tree. But the reality is we're moving into a period where we've got structurally higher interest rates and higher inflation. To your earlier point about concentration risk, the concentration risk in MSCI World is the highest it's ever been. Again, you've got half a dozen companies that account for more than 20% of the index. They've gone from a P of 22 times to 40 times. Now, so there's a lot more risk inherent in a passive portfolio today than has been the case in many years. And this is when an active manager like me, this is when we really earn our fee, because we need to be able to steer the portfolio and capital into other areas of the market that don't have that risk. So I think now is where asset allocators need to be seriously thinking about the bang for the buck that they're going to get for active management now. Don't necessarily be too backward looking, because the backward looking scenario isn't that reflective of what active management will do on a going forward basis.
Is it a bit of a paradox, Ned, that you want to be lonely in the sense that you don't want to go into a crowded trade with other institutions all over the register, but sometimes do you think when you are one of the first, are we really confident that we're seeing something that the market isn't?
Yeah, so I think cycles show that typically when there is crowding, it typically doesn't last for that long. Now, they might be famous last words, but at the end of the day, we need to just focus on the fundamentals at hand and how they pair up against the valuation. So, but to that point, the crowding point's a really important one, because of those big companies we talk about, it is stacked with growth managers, value managers, quality managers, passive managers. It's like the clown car effect, where you can't fit any more clowns in, and sooner or later the doors are going to fly off. Now, you just don't want to be anywhere near that when that actually happens. But we saw it, if you go back to 2021, I mean, we saw growth doing incredibly well in the middle part of 21. And again, if you didn't get out of the way, 2022, we saw growth lag by 12%. So that wasn't that far in the baffles where we saw a really bad unwinding of growth. And we're in sort of a similar situation now. So I think history, to some degree, should repeat itself.
What about the concentration of the United States in your universe? Does that worry you at all, that you whether you want to be or not, you tend to become a bit concentrated in US equities, or is that just simply the fact that they are, in many cases, global businesses, but they happen to be domiciled in the US?
That's exactly right. They're typically global businesses that happen to be domiciled in the US, and that's changed a lot. I mean, when I started my career, you had all these fantastic Japanese companies that were in the top 25, and a lot of those are now SMID caps. I mean, Sony is almost a SMID cap now, which is quite extraordinary, given it was in the top 25 companies globally 20 years ago. But when you think about the US and you think about, again, some of these companies, like whether it's Amazon or Alphabet, they're just huge global businesses. And likewise, when you switch gears to Europe, there's not as many sort of global leaders in Europe as what there used to be. Europe tends to be a bit more dominated by the big industrial companies that have done very well off the back of the strong period of China, but obviously that's waning now. And you've got some leaders like LVMH and Novo Nordisk, but Novo Nordisk, I mean, that's really just a global leader in what they do, as is Hermes or LVMH.
Do you find, Ned, that you actually prefer to buy those in New York in ADR form or secondary listing and just keep everything in the one currency? Or do you still want to, for non-US companies, actually go to them and buy the main listing?
We typically go to the main listing sort of in their domicile. So we're somewhat ambivalent. We don't really feel the need to necessarily go and buy the ADRs or the GDRs. For an individual investor, that might make more sense. But as a fund manager, we're happy just to go to the domicile, to the main listing.
How do you think 2023 will look at the end of the year for global SMIDs?
So we're very positive. We're very optimistic because at the moment, if you think about the year to date, so this year has been a trough year for earnings globally for all caps and for SMIDs. So we've had huge earnings rebound after COVID, moderate growth year last year, flattening out this year. To my earlier point, as we get closer towards the end of the year, the markets will realise there's 15% growth sitting right in front of you and you're paying 15 times earnings for it. That opportunity set will just be too attractive. And sooner or later, that small mid-cap part of the market has to play catch-up. I'm not saying it's going to go to 40 times earnings, but theoretically, it could put on 4 or 5 PE points. And we don't see any reason why that asset class couldn't appreciate by 25 to 30% in the next 12 months.
Always fascinating to chat about this arena that you invest in. It's a really interesting field. This has been In Depth with Ned Bell. It's been a pleasure, Ned. Thank you.
Thanks for having me.